Hello, my name is Chiew, and today we'll be covering the collapse of Signature Bank in March 2023. So, they established in 2001 and were listed on the Nasdaq in 2004. They are an FDIC-insured New York state-chartered commercial bank, and at the time of their collapse, they were the 29th largest bank in the USA and owned 40 private client offices across New York City and as well as West Coast of the USA. So, this building here is actually their headquarters. Right, so their core businesses revolve around commercial real estate and commercial and industrial lending. In fact, they were the third largest commercial real estate bank in the New York City, and they specialize in multifamily housing loans and mostly work with medium-sized enterprises. They expanded their core services which firstly consisted of the fund banking division in 2018, which was dedicated to providing financing and banking services to the private equity industry. This division experienced rapid growth in 2021 and accounted for 41% of Signature Bank's total loan portfolio. They also launched a digital assets banking group in 2018, which handled cash deposits and managed accounts for asset-related businesses. And then Signa in 2019, which was a blockchain-based digital payments platform, and they partnered with crypto giants like Coinbase. Right. So around the period of its collapse, Signature Bank actually operated in a macroeconomic environment of rising inflation, which was mainly caused by the Russia-Ukraine war and COVID-19. Inflation rates peaked at 9.1% in June 2022 and 5% where they collapsed in March 2023. And this was way above the healthy inflation rate of 2 to 3%. Right, so the Fed thought that the inflation was transitory and kept interest rates low to stimulate economic growth, but they were wrong and realized too late, which resulted in them hiking up the interest rates by 5 percentage points over the next 1 year only, which was the most aggressive hike since 1981. Right. So the interest rate hikes actually reduced customer spending ability, which slowed economic growth. And the constant expectation of interest rate hikes actually caused fears that banks will struggle to service their debt. And this is detrimental as it could push banks to financial difficulties, especially those holding long-term bonds. Right, so the liquidity tightness due to interest rate hikes caused investors to become cautious, and this influenced them to stay away from volatile stocks like crypto. And this caused the 2022 crypto winter, which wiped out $2 trillion in crypto assets. So the massive crypto exchanges like FTX collapsed, and Bitcoin dipped by 67.53% from 3rd January to 21st November. Right, so there's an internal culture centered around prioritizing business growth. For example, they became the first FDIC-insured bank to launch a blockchain-based digital payment platform. And this culture ultimately allowed their assets to increase by 60% from 2020 to 2021. So moving on to the risk drivers, Signature Bank was affected by, firstly, the interest rate hikes as they put a lot of money into long-term investments, causing them to accumulate unrealized losses of 9.8% from their hold-to-maturity assets in 2022, which heightened liquidity risk. This chart over here actually shows that Signature Bank has a higher long-term investment to assets ratio than most banks in the USA, and at one point had almost half their assets over here in long-term investments, heightening liquidity risk. So liquidity risk was actually a key factor behind Signature Bank's collapse. It was driven mainly by Signature Bank's over-reliance on uninsured loans and as its primary source of growth. So Signature Bank actually targeted clients on their willingness to deposit large sums of money, which often was above the FDIC-insured value of $250,000. So these uninsured loans are unstable as customers are more likely to withdraw their deposits during market stress as they stand to lose a lot of money. And by the end of 2022, Signature Bank had 49% more of its portfolio made up of uninsured loans than other peer banks. Right, so it became clear that Signature Bank's rapid growth was not supported by robust risk management practices, and their liquidity risk management actually became the most concerning department for the FDIC. So Signature Bank's management actually did not heed the FDIC's concerns as they were complacent that customers would stay loyal, and the management was described by FDIC supervisors as reactive and not proactive. It relied on liquid assets position to offset uninsured deposits instead of an appropriate contingency plan as advised by the FDIC. And this position suffered a hit because of the crypto winter and interest rate hikes, which further enhanced Signature Bank's liquidity shortcomings. So by the time it collapsed, the FDIC assigned Signature Bank the lowest possible liquidity component rating of 5. So, as mentioned earlier, Signature Bank was heavily linked with the crypto market, with digital-related deposits making 30% of their total deposit portfolio at the end of 2021. So this caused public and media scrutiny towards Signature Bank after the crypto winter hit. From this chart, we can see that while the crypto industry was taking massive hits, Signature Bank's stock actually plummeted along with it. So even though Signature Bank's stock started dipping at the start of the year, they waited till November 2022 to blunt the impact of these events on the stock price. And Signature Bank actually issued a press release in November 2022, which declared that it only had deposit relationships with crypto companies whose deposits comprised only 0.1% of their overall portfolio. It also announced a reduction of digital assets industry deposits below 20% of their total portfolio. Once again, this slow response was reactive and not proactive. So the US banking crisis in 2023 was basically the nail in the coffin that exposed the liquidity shortcomings of Signature Bank. So after the turmoil of Silvergate and Silicon Valley Bank, the media and public feared that Signature Bank was experiencing a crisis too, because just like Silvergate Bank, Signature Bank was heavily linked to the crypto industry, and just like Silicon Valley Bank, Signature Bank relied heavily on uninsured loans, deposits. So, despite all this, Signature Bank's management were not too concerned, as they thought that they were different from the other banks, and this caused them to be extremely unprepared for the 1,600 withdrawal requests, amounting to 18.6 billion US dollars the next day, which put Signature Bank at risk of technical default on payment obligations. So by Sunday, Signature Bank's withdrawal requests had actually overpowered their liquid assets. So throughout the weekend, Signature Bank scrambled to find ways to stay afloat. However, due to subpar risk management practices, Signature Bank management actually had no idea how much borrowing it required to fund pending withdrawals, causing them to approach the Federal Home Loans Bank too late to draw against its credit line. And they also lacked collateral pledge at the FDR New York to cover wire requests. In the last-ditch attempt, Signature Bank actually tried to rig their accounts, for example, declaring they had additional $5 billion in pledgeable assets to tank the withdrawals on 13 March when they only had, in reality, $900 million. And after all that, on 12 March 2023, New York State Department of Financial Services took possession of Signature Bank, with the FDIC declared as its receiver. So here's a fun fact about Signature Bank. They were actually the go-to lender for the Trump organization, and Ivanka Trump actually sat on their board for a few years. However, they severed ties with Trump in 2021 because he instigated a Capitol Hill riot, which actually caused the death of 5 people. So yeah, that's the end of my analysis. Thank you.